For this mock exercise, we're going to take a look at capital budgeting decision and cost analysis. And again, we're going to use the methods that's used to evaluate capital budgeting long-term decisions, such as NPV, payback, and accounting rate of return. This question does not have internal rate of return, IRR, but certainly we could probably do IRR in this question as well. But that question didn't focus on that, so we're just going to ignore it for this one. And the question that we're going to do is called Tube Fab Inc. So let's take a look at the question. So this company is thinking about replacing an old metal tubing machine that was acquired 2 years ago at $50,000. Now, is that relevant? The answer is no. That information is not relevant because it's not going to impact. Those are past costs. And again, we've already bought, we've already decided, we've already paid, so it becomes irrelevant decision making. The machine is still in good condition. So let me put the word irrelevant here. Good condition, but management wants more flexibility and lowering manufacturing cost. The current market value of the machine is $20,500. Is that relevant? The answer is yes. And with a salvage value of $2,000 at the end of 10 years. Okay, so that's relevant. We're going to talk about how we're going to incorporate that in the question. Now, a manufacturer is offering a new tubing machine at a cost of $60,000. And this machine would last for 10 years. Salvage value is $4,000, so we're going to need that. Now, we're going to compare the salvage value of the old and the new. We'll see that in a minute when we do the comparison chart. The new machine will require an additional $5,000 working capital, for which it will be recovered at the end of 10 years. So there's going to be a working capital requirement, and there's going to be a working capital release. With the new machine, the management estimate an important decrease in manufacturing cost. So you can see that the labor goes down, the machine cost goes up, cleanup was down, amortization, and so on. Now, the question is, they want a minimum desired rate of return is 8%, and the payback period is 4 years for the cutoff. They want us to do the NPV first. So let's do that. So in calculating NPV, we want to look at the incremental cash flow. The first thing you want to do is let's evaluate the incremental cash flow. So what I like to do is I like to show the old versus the new. And remember, we're always looking at it from a point of view of what would be the impact if we move to the new machinery. So the cash flow, the direct labor, we saw that the new is $7,900, the old is $13,500. So there's going to be an inflow or savings of $5,600. Okay, machine, setup, cost. The old is $3,000. The new is $3,400. So we're going to have a net outflow of $400. Now, what about cleanup and setup? That's $2,500 for old and $1,200 for new. So it looks like we're going to get a savings of $1,300 for that. Now, amortization is not relevant, right? Amortization is just an allocation of capital cost over the life of the asset. So to us, it's not relevant. So the total cash flow effect is 19,000 versus 12,500. So there's a positive cash flow of 6,500. Now we're going to use the same 4-column approach. So you've got years, you've got amount, you got PV factor, and remember we want this to be an 8% required rate of return and the present value dollar amount. So the first thing is we're going to get an investment. How much is this going to cost us? 60,000. So that's time 0, which is now. So I call it 0 equals now. And it's minus 60. The present value factor is going to be 1 because it's today. Now, what else do we need? We know that we're going to get a salvage value of 20,500. So this is the salvage value of old. We need to know that because that's going to be a cash inflow, isn't it? Now, what else? We're told that there's a working capital requirement. And that one is for 5,000. So we're going to take that because that's a requirement. And basically it means that we're not able to use it or to utilize it or to make interest income on that. Now, what we have is we have this annual cash savings, right? Annual cash savings. And that's going to be for 1 to 10 years, right? So 1 to 10 years. And that one is 6,500. And the present value factor is going to be 67101. That's I equals 8, N equals 10. And that gives us 43,616. Now, we've got working capital release at the end of 10 years. And that's that 5,000 plus. But because we've got a, it's not generating revenue in terms of interest, the present value of that amount is going to be less. So we need to use time value money factor, I equals 8, N equals 10. Now, what is the difference in terminal value? In salvage value, let's call it terminal value. So the new terminal value is 4,000. The old terminal value is 2,000. So by buying the new machine, there's a 2,000 terminal value difference. So that 2,000 is how I got this at 4,632. You could see that when you add all this, we get 2,358. So NPV positive means that it is worth buying the new machine. Now, it says, what is the point of indifference? So that's the second question now that we're doing. It says, what is the point of indifference in terms of the annual cost savings? What is it actually saying? What the meaning of that question is, at what point are we then indifferent whether we should replace the old and the new? And at that point of indifference is when NPV equals 0. So that's what we're trying to calculate. We're saying that what would the cash flow need to go down by to make NPV go to 0? So point of indifference is when NPV equals 0. So how do we do that? Well, we know that the cash outflow is minus 60 plus the salvage value minus the 5, right? So all of that is the minus 44,500. So we know that it's going to be minus 44,500. Okay. We also know that the present value factor, so let's X equals the annual cash flow. So X times the present value factor of 6.7101, right? So that's this one. So we want to know what this is, X. Now, these two are not going to change because the working capital release and the difference in terminal value are going to remain the same. All we want is we want to know the flexibility, the how much should annual cash flow be estimated. So here, we're going to actually add 926 and 2316. So we want those two to equal. So X equals, solve for X, 614864. So what we're saying is the annual, therefore, the annual cash flow savings could actually go down to 614864 from 6500. Okay, so that we are indifferent. So like remember, a lot of these are assumptions that management made, and there's a lot of bias as well. So if you think about it, much of the data in terms of annual cost savings between old and new, it's going to have some bias in it because it depends if management wants to change the new machine or not. It may come up with perhaps an estimate that might be over, or that might favor one option over the other. So this is what they call the point of indifference. Part C asks for payback. So how do we determine payback? It's going to be the cost of the investment, which will be 44,500 divided by 6,500, 6.85 years. Now, you could argue that this included the working capital requirement. So perhaps without working capital requirement, it would be 44,500 plus the 5,000 divided by 6,500. Because what we want is we want to know the cost of the investment really is going to be 44,500 plus the 5,000 is 49,500 divided by 6,500 is 7.615 years. Now what was the minimum? The cutoff is 4 years. So therefore, cutoff is 4 years. So this is a no, right? Because the payback is much, much higher. Now, next is, again, this is with working capital requirements and without. Now, number D is the accounting rate of return. So how do we determine the accounting rate of return? Okay, so we know that the cash flow, net cash flow, is 6,500. We calculated that in part A. Now, what's the amortization? We saw that the amortization is 4,000 for old and 5,600 for new. So we're looking for the change in amortization, which in this case is minus the change in amortization expense, which is 1,600. Okay, so let me just write that down up here. It's 5,600 less 4,000. That divided by the investment, 44,500. Again, I would have actually taken the 44,500 excluding the working capital release. So this is including working capital. The accounting rate of return would be 6,500 would be about 11%. Or we could do it this way, 6,500 minus 1,600 divided by 44,500 plus the 5,000, which is the 49,500. .89%. Okay. Now for part E, it's asking us, based on your calculation above, state your conclusion on whether we should buy the new tubing machine or not. So looking at the quantitative, first one, NPV greater than 0, so it's a go. Number 2, payback is greater than cutoff. That means it's a no. And the accounting rate of return is greater than the required rate of return of 8%. So either one of these still gives us the 8%. So this is a yes, so go. Now, qualitatively, so the one thing we want to make sure is what is the impact to existing employees if we're changing the new machine. Why? Because look at the labor cost goes down, right? The labor cost went down from 13,500 to 7,900. So there's going to be layoffs. So layoffs, we want to know what the impact is to the existing employees with the layoffs. And 2, because the new machine is new, we want to know whether the quality is as good or better than the old machine. And we also want to know whether it is efficient. Right? Whether it is efficient as the better for cleaning and setup. Because remember, in cleaning and setup, the new machine is more than half the cost of the old machine. Okay? Thank you.